Welcome to our comprehensive guide on how India's tax system, particularly the Goods and Services Tax, or GST, and various income tax slabs, profoundly influences investment decisions for both domestic and foreign entities. This video aims to break down how these policies affect business profitability, sectoral attractiveness, and long-term capital allocation strategies. We'll start with a brief overview of the GST structure in India, which comprises rates of 0%, 5%, 12%, 18%, and 28%. We'll also touch upon the income and corporate tax slabs and their associated surcharges. Understanding these foundational elements is crucial before delving into their impact on investment decisions. So, why do taxes matter so much when it comes to investment decisions? The answer lies in their direct link to after-tax returns and capital allocation. For any investor, the ultimate goal is to maximize returns, and taxes directly reduce the net profit on an investment. This reduction isn't uniform. Different tax rates apply to different sectors, income brackets, and types of investments, leading to varying after-tax returns. The direct link between after-tax returns and capital allocation means that investors will naturally gravitate towards opportunities that offer higher net returns. This influences how capital is distributed across various sectors and asset classes. For instance, a sector with lower effective tax rates might attract more investment compared to one with higher tax burdens, even if their pre-tax returns are similar. Furthermore, taxes significantly influence the risk-reward calculations for investors. A higher tax burden can make a seemingly attractive investment less appealing by disproportionately reducing its potential upside, especially when compared to its inherent risks. Investors assess whether the potential after-tax gains adequately compensate for the risks involved. This includes not just income tax on profits, but also indirect taxes, like GST, which can impact operational costs and consumer demand, thereby affecting overall profitability. Now let's dive into how GST specifically impacts various sectors in India. The differing GST rates have created distinct advantages and disadvantages for different industries, thereby shaping investment landscapes. This differentiation is critical for understanding where capital flows and why. High GST sectors, such as luxury goods, tobacco, and automobiles, face higher tax burdens, which can lead to increased product prices and potentially reduced consumer demand. This directly affects the profitability and growth prospects of businesses in these sectors. Conversely, low GST sectors, including essentials like food, healthcare, and education, benefit from lower tax rates, making them more accessible to consumers and potentially more stable for investors. This distinction influences investment choices significantly, as investors evaluate the long-term viability and growth potential based on these tax implications. This sectoral impact shapes private equity, venture capital, and retail investor choices. Private equity and venture capital firms often seek sectors with favorable tax structures that promise higher after-tax returns and easier exits. Retail investors, too, consider the tax implications when choosing where to allocate their savings, favoring sectors that offer better value or growth due to lower tax burdens. Moving on to the corporate tax environment. India's corporate tax rates play a crucial role in its global competitiveness. Understanding these rates and the incentives provided is essential for both domestic and foreign investors. India has progressively lowered its corporate tax rates to attract investments and stimulate economic growth, aiming to be competitive with other major economies. The current rates, along with any surcharges, determine the net profitability for businesses. This global competitiveness is vital for attracting foreign direct investment, as businesses often compare tax regimes before deciding where to establish or expand operations. Beyond the standard rates, India also offers specific tax incentives for manufacturing companies, startups, and special economic zones, or SEZs. These incentives, which include reduced tax rates, tax holidays, and exemptions, are designed to promote particular industries or regions. For instance, incentives for manufacturing aim to boost local production and job creation, while those for startups encourage innovation and entrepreneurship. Investors look for these incentives to enhance their after-tax returns and gain a competitive edge, making these sectors or zones particularly attractive. Now let's explore the intricate relationship between indirect taxation, consumer demand, and its significant impact on foreign direct investment, or FDI. This connection is crucial for understanding how tax policies can shape market dynamics and investor confidence. GST, as an indirect tax, directly affects consumption patterns. When GST rates are high on certain goods or services, it increases their final price, which can discourage consumer demand. For example, if luxury cars have a higher GST rate, it makes them more expensive, potentially leading to fewer sales. This impact on demand directly affects the revenue and profitability of businesses in those sectors. Investors keenly observe these patterns, as a shrinking consumer base due to high taxes can signal reduced growth potential, making a sector less appealing for investment. For foreign direct investment, tax clarity is a significant driver of global investor confidence. A transparent, stable, and predictable tax regime, especially with a unified indirect tax system like GST, assures foreign investors of a level playing field and reduces uncertainties. Before GST, India's fragmented state-level taxes created complexities and inefficiencies for businesses operating across multiple states. GST's introduction created a unified national market, simplifying compliance, reducing cascading taxes, and streamlining logistics. This unification has been a major factor in attracting FDI, as it makes India a more attractive and easier place to do business for global companies. Next, we delve into the critical role of GST in the infrastructure and real estate sectors. These sectors are significant drivers of economic growth, and their performance is closely tied to tax policies. GST's role in real estate transactions is multifaceted. It applies to services related to construction, development, and specific types of property sales. For instance, GST is applicable on under-construction properties, impacting the final cost for buyers and the revenue for developers. Additionally, input tax credits play a crucial role here. Developers can claim input tax credits on raw materials and services used in construction, which helps reduce their overall tax burden. This mechanism is vital for project viability and profitability, especially for long-term infrastructure projects. The ability to claim input tax credits ensures that developers are not taxed on taxes already paid, thus preventing cascading effects and potentially making large-scale projects more financially feasible. This clarity helps streamline costs and makes investments in infrastructure and real estate more predictable. While the Indian tax system has evolved to be more investor-friendly, it still presents certain challenges and risks. Understanding these is essential for any investor planning to navigate the landscape effectively. One of the primary challenges is the complexity in compliance. Despite efforts to simplify, the sheer volume of rules, differing interpretations, and frequent updates can make it difficult for businesses, especially smaller ones, to remain fully compliant. This complexity often leads to increased operational costs and the need for specialized tax expertise. Another significant risk is litigation around GST disputes. Disagreements over tax interpretations, valuations, or credit claims can result in lengthy and costly legal battles, tying up capital and resources. Lastly, policy uncertainty can act as a deterrent. While India has made strides in tax reform, abrupt changes in regulations or interpretations can create an unpredictable environment, making long-term investment planning challenging for both domestic and foreign investors. These factors necessitate careful due diligence and a proactive approach to tax management. Looking ahead, the future outlook for India's tax system, particularly regarding GST, points towards continued reforms aimed at enhancing ease of doing business and bolstering investor confidence. Expected reforms include further rationalization of GST structures, potentially reducing the number of slabs or simplifying compliance procedures. The long-term vision is to create a more stable, predictable, and transparent tax regime that fosters a robust investment climate. This includes leveraging technology for seamless compliance, reducing human intervention, and providing clearer guidelines to minimize disputes. The ultimate goal is to make India an even more attractive destination for capital, encouraging both domestic expansion and increased foreign direct investment, thereby driving sustainable economic growth and job creation. These ongoing reforms are a testament to India's commitment to improving its business environment. In conclusion, India's tax slabs, particularly GST and income tax, are fundamental in shaping investment decisions by directly impacting profitability, influencing sectoral attractiveness, and driving investor confidence. Understanding these dynamics is crucial for strategic capital allocation. Please remember, this video is for educational purposes only and should not be considered tax or financial advice. Taxation laws are subject to change, and viewers should always consult qualified professionals for personalized investment decisions. Thank you for watching.